What is up, guys? So today I thought I'd do a video on the financial sector due to the fact that they pretty much are going to kick off earnings season starting on Friday. We're going to have a lot of heavyweights such as Citi Group, JP Morgan, and Wells Fargo reporting earnings. And I know I usually cover cryptocurrencies and sort of those markets, but I thought it would be important to kind of cover the financial sector due to the fact that it's been lagging and underperforming in the market as of late. And a lot of people that are in the cryptocurrencies really don't take a liking to the financial sector as a whole in terms of banks such as JP Morgan, Goldman Sachs, Deutsche Bank, and all that good stuff. So today we're going to explore the reasons why the financial sector has been pretty much taking a beating, even though we had the Trump tax cuts, all of this deregulation happening. So you would think that with all of these tax cuts and all of the cash that's being returned to these banks, they would be doing well and their stock price would be reflecting that, right? So if the tax cuts are returning more cash to these companies, that gives them the option of share repurchases to increase their dividends, to return capital to shareholders, and invest in their business. But as we've seen in the equities market, especially in technology, everything has just been on an absolute rip. Up until now, we've had some recent volatility, but the standout would have to be the financial sector that isn't doing too well. So if you guys are new here, please subscribe to the channel if you kind of want to stay updated on things like this, and always message me on Facebook. That's how I stay in contact with most of you guys. So let's just take a look across the spectrum here. If we start off with the XLF ETF, which is the Spider Select Sector Fund for the financial sector, which involves all of the bank stocks pretty much. And as of late, pretty much starting in March, we've been down about 12%. Going over to Citi Group, down 16%. JP Morgan, down 12%. Morgan Stanley down 20%, Goldman Sachs down 20%, and Deutsche Bank I didn't even want to put up on the screen because it is depressing to look at. So one of the things I wanted to show you guys, the reason why banks aren't doing well, even though we had all of this economic easing as we've been seeing with the Trump tax cuts and deregulation, is something called the yield curve. And for those of you who don't know what the yield curve is, it's essentially the spread between shorter term yields and longer term yields, right? So if we look at the treasury market in terms of US treasury bonds, we'll see that the spread between the 10 yield, right? So the 10-year treasury has a yield of 2.824%, and the US 30-year yield has a yield of 2.931%. And the reason why this is important is because this hurts the banks because it cuts into their net interest margin. So banks pay interest on shorter term loans, but they loan out to us at the longer term rates. So I was reading an article in Investors Business Daily that was kind of going over this. And what it says is it's not going to be advantageous for banks to lend out anymore to make money if, for example, they have to borrow at the 10-year yield and that's at 3%, and the 30-year yield is only at 2%, right? So it's costing them money to lend out. So when the economy's ripe, when the economy's quote unquote healthy, even though we've had artificially suppressed interest rates, banks such as JP Morgan, Goldman Sachs, all those big players will pay interest on shorter term bonds, which, for example, say the 10-year yield, they will borrow money and pay interest on the 2.8% and lend out to us at the 2.9%, making a profit, right? So, but as of recent times, a lot of investors have been flooding into the longer term yields as sort of a safe haven. So what that's doing is that's driving down the yield of the longer term bonds. And while the Federal Reserve is constantly hawkish on the economy, they are increasing interest rates on the shorter term yield. So what that's going to create is a yield curve inversion, right? So what's going to happen is you're either going to have a flat yield curve where you're pretty much not going to have a spread of any basis points between the shorter term bonds and the longer term bonds, or you're just going to have a complete inversion where the shorter term rates are higher than the longer term rates. So that's going to cause incredible strain on all of these banks, and it's going to really eat into their balance sheets should we have an economic downturn. And another reason why I wanted to talk about the yield curve here is not only due to the financial sector, but due to pretty much any sector across the equities market as well. Because switching off here from the financial sector, if we look at any company in terms of tech, in terms of fintech, you'll see that since pretty much the crash of 2007 and 2008, US companies have taken on $14 trillion in debt. And that's the reason for that is it's due to the artificially low interest rates. So they've taken advantage of all that cheap debt. But now that the Federal Reserve understands that the economy is sort of overheating, what they're going to do is they're going to continue to raise interest rates, and that's going to put strain on a lot of US companies. It's going to put a strain on a lot of companies in the financial sector, such as Goldman Sachs, JP Morgan, and the like. And it's going to make it increasingly harder for them to service their debt, right? So let's say, for example, Facebook is taking on millions and millions of dollars, but they only have to pay 2% interest. But as the interest rates rise, you are going to have to pay more money. And so as consumers are strained, because if I could make a whole other video, but I really don't want to make this video too long. But I can make a whole other video on consumer debt and the problems we see there. Because with consumers, with household debt, you have credit cards, you have student loans, you have auto loans, all these subprime auto loans. And in addition to having your mortgage. So as interest rates increase, your credit card payments are going to go up. So if you had a $100 minimum payment on your credit card, with interest rates rising, your Visa, MasterCard are going to raise the rates on your credit card. So instead of paying $100 a month, you're going to have to pay $150 a month, right? And a lot of people aren't budgeted for that because they're living paycheck to paycheck. And this is exactly what happened during the crash of 2008 when we had that mortgage crisis, because interest rates went up, people's payments on their mortgages went through the roof, and everybody started defaulting, creating sort of a downward spiral, waterfall of everybody defaulting on their loans. Banks were insolvent, and we went into a financial recession, which is probably the same thing that we're going to happen now. But the reason why I wanted to make this video is because I'm an equity derivatives trader, right? I trade derivatives on the equities markets. Pretty much what that means is I trade options, right? So I'll purchase a call if I think that a stock is going to go up, or I'll purchase a put and short the stock if I think the stock is going to go down. So as earnings come on Friday, I may take a short position on some of these financial stocks. But then what I'm saying is, as we've seen a lot of these companies take, a 15 to 20% hit so far. So what I think may happen here is that this is already priced in. All of this yield curve action may potentially be priced into these stocks, and should these financial companies, put in earnings beat, we could see, some upward price action there. So, for all of you equity derivatives traders out there, just be cautious, be careful. I may not trade this at all, but I just wanted to make this video to kind of explain what the yield curve was, why it's important, and, kind of why it's a predicator or a predictor of future economic downturn, right? So once the yield curve inverts, that doesn't mean that we're going to have a recession the next day. If you look back through history in the 2007, 2008 financial crisis, the yield curve inverted. We had about a 9-month to 2-year grace period. And then you have your crash. Going back even further to the dot-com bubble of 2000, you had your yield curve inversion. And then about 9 months later, you have your crash. And funny enough, the Federal Reserve came out with all of these Federal Reserve stress tests on a lot of these financial institutions, a lot of the banks. Obviously, Deutsche Bank failing that, which essentially means that should there be a recession or a downturn in the economy, kind of like what we had in 2008, would these banks still be solvent? Would they be able to run their operations, lend out money, and still, be profitable as a bank, right? So Deutsche Bank failed that. But the thing that I've been seeing from a lot of economists out there, I've been listening to some Peter Schiff's podcast. I know he's a little bit radical, but I do think that some of his points are definitely viable, is that the Federal Reserve only does the stress test up to worst case scenario of 2008. But what we have now is we don't just have a mortgage crisis. We have a student loan crisis. We have credit cards. We have auto loans, subprime auto loans, right? So we have a bubble across every single asset class pretty much that exists except the commodities sector, in my opinion, of gold, silver, palladium. So what's going to happen is we're going to have a recession that's worse than 2008, and the Fed didn't even make a stress test for that. So how do we know if these banks are going to be solvent or insolvent should we have an economic depression that is worse than 2008, worse than 2007 and 2008? So I just wanted to make this video. Keep a watch out, guys. That's why I always say that, strive to become your own central bank, right? So I always suggest you guys watch Gregory Mannarino if you really want to get a full grasp on what's going on with this whole yield curve and the Federal Reserve and manipulation of commodities markets. He's a really good resource to go to. But definitely the two resources that I study pretty much all week is I buy a copy of Barron's at Penn Station and I buy a copy of Investor's Business Daily and read them both cover to cover twice, right? Because I always want to be staying up to date on what the market's happening, what's going on in the markets, so I can best position myself for an economic downturn. So that concludes the video for today, guys. If you made it all the way through, thank you. Leave a like, subscribe. I know a lot of you guys have been messaging me on Facebook wondering where all these videos are, how come I'm not making videos. And it's because I've been doing a lot of work with this fintech hedge fund, writing a lot of articles that are published in Forbes. And I wrote an article that got featured by The Key. So The Key cryptocurrency, I wrote an article that got published in Forbes magazine, and I've made a shameless plug on The Key. So I'll leave all of that in the description, and I will see you guys next time. Thanks for watching.